and they're right, but we have here a line in the sand here, a pivot point. This is the point of the 2015 low in the ratio, and we're about to break through it again. We have knocked on this number many times. 1, 2, 3, 4, 5, 6 is the 7th time since 2022, and we're going to break through. And once we break through, I think we're going to be on a multi-year, if the monetary system lasts out, it will be in a multi-something. It'll be a long time where gold is going to outperform stocks. And once that happens, more and more people are going to pile in.
Rafi Farber highlights that although gold has doubled since its 2015 low, it has still underperformed compared to the S&P 500, keeping mainstream investors focused on equities. However, the gold-to-S&P ratio indicates that this trend may soon reverse. Gold is approaching a key resistance level established in 2015, potentially signaling a shift in favor of gold as the economy faces challenges. Gold buying has gained momentum this year, and prices are now near all-time highs, making it one of the best-performing assets since Diwali with a notable 32% return, surpassing the S&P BSE Sensex's 25%. Amid global economic and geopolitical tensions, gold's impressive performance reaffirms its role as a safe haven asset. Silver has also performed well, delivering returns of over 35% during the same period, with both metals outperforming most other asset classes this year. Gold has risen by more than 33% in 2024, and as it continues to outperform the S&P 500, analysts who once dismissed gold are now recommending holding bullion. Farber suggests that if gold can break through this critical level, it may herald a multi-year period where gold outpaces stocks, drawing more investors who realize their stock-based portfolios may be losing real value despite nominal gains. As October ended, gold hit a new all-time high of $2,800, though profit-taking led to a slight $50 drop, resulting in a 3.4% gain for the month. This steady strength in gold prices, even with a rising US dollar and higher treasury yields, underscores its appeal as a stable investment amid economic uncertainties. For more expert insights, subscribe to our channel and turn on notifications so you won't miss out on future updates. Your support means a lot to us.
Why nobody cares about the gold run and why that changes soon. This is a chart of the gold to S&P 500 ratio. So you see here a few things I wanted to point out. We see a head and shoulders bottom here with the head at 2022 over here where I'm circling and the shoulders at 2018 and 2024. Head and shoulders bottoming pattern, and we have broken through both the 50-week moving average and the 200-week moving average, and we have a golden cross, which I think I pointed out last week. The blue line, the 50-week moving average, is crossed above the 200-week moving average, excluding 2020. This is the first time that this has happened since 2001. I pointed that out last week, but the point here is that the reason that nobody cares about the gold run, by nobody I mean the mainstream, they don't care about the gold run, is because since 2015, look here, 2015, I have this highlighted, the low in 2015, the ratio was 0.503. We are now at 0.44. So despite gold's bull market since 2015, at 2015 it was at 1054 low, I think, and now it is at 2760. So it is more than doubled. Gold is more than doubled, but it's still underperformed the S&P 500 despite that. And it's very frustrating for gold bugs and the stock stackers. Can you stack stocks? Well, let's just call them the bubble chasers. They are saying, you know, and rightfully, that the stock market, S&P 500, has still outperformed gold since then, and they're right. But we have here a line in the sand here, a pivot point. This is the point of the 2015 low in the ratio, and we're about to break through it again. We have knocked on this number many times. 1, 2, 3, 4, 5, 6 is the 7th time since 2022, and we're going to break through. And once we break through, I think we're going to be on a multi-year, if the monetary system lasts out, it will be in a multi-something. It'll be a long time where gold is going to outperform stocks. And once that happens, more and more people are going to pile in as they realize that in real terms, their portfolios are evaporating, even if their dollar amounts are rising, because their gold ounce amounts.
Rafi Farber points out that if the Federal Reserve resumes printing money due to dwindling reserves, silver could see a substantial price surge. This scenario could spell challenges for stock investors, as they might experience significant losses in real terms. Historically, silver lags behind gold at the start of a precious metals bull market. In the last bull run, silver skyrocketed by 1,000%, reaching its all-time high of $50 per ounce in April 2011. Recently, silver tested a critical 12-year resistance level at $35 and has already gained over 40% this year. The recent liquidation of short and medium-term bullish positions in the $32 to $35 range may pave the way for long-term buyers to enter the market decisively. This strategic shift could set silver on a path toward a new all-time high, potentially surpassing the $50 mark by the first quarter of 2025. Now, let's return to the interview.
The short-term silver technical picture is this. Here is the trend line since August when we were at 26. Now we're at 32.80. We're still above that trend line. We would tag it here at about 32. We're also at a support zone, which we hit in September and October as resistance, and also in May as resistance of about 32.80. We'll see if we bounce here. Silver can be very volatile, and once the Fed turns, once the reverse repos run out and the reserves go down and then they have to print more, silver is going to turn around violently, and it's going to be scary for stock market stackers because they're going to start losing real value quickly. The bigger silver picture here technically is that we have a line. I forgot to draw it in here. I did draw it in, but it's not here. I guess I put the wrong picture in. But we're at this resistance line of 35. You can see it's the same area as was resistance from 2011 to 2013 before the bear market really started. So we're at that point here. So the fact that this is resistance again is not particularly surprising to expect to slice through this very old resistance all the way back from 2011 is pipe dream thinking, but we will slice through it. It's going to take a little bit longer, maybe a few weeks, maybe a month or two. Maybe it'll be timed with the Fed turning around after the next banking crisis. We'll see, but it's close at hand. QT has slowed by 37% since June. You can see here the numbers that I put in. At December, the balance sheet was at 7.7 trillion, and 22 weeks later, when the Fed started to slow down QT, it was at 7.284 trillion, and now it's at 7.013 trillion. So the rate of decline in the balance sheet is down by about 37% from these 22 weeks to those 22 weeks. They have slowed it down, but they have not slowed down the percentage of dollars that are being backed by literally nothing, and that is the back-end mechanism of what hyperinflation actually is, when the assets of a central bank are worthless that back the liabilities, which is the currency. Bank reserves are steady. These are the reserves, the extra dollars, that if they fall below 3 trillion, we should be at the next banking crisis. You can see here the red lines, all point to month ends when bank reserves tend to fall. And they probably will fall this month too. The numbers will be in at the end of the month. This data is good until October 30th for Wednesday. And it could be a very violent drop given how much money has been vacuumed out of the system thanks to those treasury auctions that cleared last week.
The current outlook for gold and silver suggests a potential shift in investor focus as traditional asset classes encounter rising volatility. Gold is showing strong returns and approaching key resistance levels, fueling optimism that it may soon outperform the S&P 500. This has prompted mainstream investors to reevaluate their strategies. The recent performance of both gold and silver reinforces their status as safe haven assets amid ongoing economic uncertainty and geopolitical tensions. With significant buying occasions like Diwali on the horizon, momentum in precious metals could further enhance their appeal. If historical trends hold, a surge in silver prices might follow the bullish trend in gold, creating a compelling scenario for investors who may need to reassess their portfolio balance. As inflation and currency devaluation continue to erode the value of traditional stock investments, the evolving dynamics in precious metals offer a unique opportunity. How should investors approach their asset allocation in the coming months to maximize returns while managing risks? Share your perspective in the comments. And if this video resonates with you, join our community by subscribing and hitting the bell icon for updates. Thank you for being part of our community.